Hey, Slick Talkers, thank you so much for tuning into this podcast. And I know that if you love this show, you'll also love my morning show called Good Morning Hospitality with my co hosts Michael Golden and Brandy Canali, as we spend 30 minutes every Monday morning to dive into the industry's top latest news and trending topics. So go check it out on wherever you find your podcasts at Good Morning Hospitality. And you can live stream with us on Monday mornings on LinkedIn, Twitter, Facebook, and of course, YouTube. Now, I hope you enjoy this episode.
We're seeing a cost per lead anywhere between $200 to $300. So this doesn't count your organic traffic that's coming in through your website. This doesn't count potentially a referral from a realtor. This doesn't count a referral from somebody else, but just the proactive direct mail, proactive PPC, any list-based retargeting through Facebook, Instagram, LinkedIn, things like that. We're seeing an average cost per lead of like $200 to $300, which at first blush sounds higher. Man, I'm paying that kind of money for it. But if you go through the math of it and you go through the calculations, it actually is well worth it. We're typically seeing a conversion rate, and it really depends. It depends on your program. It depends on the closing capabilities of the person that's actually answering the phone, things like that. But we're seeing conversion rates anywhere between 10 and 25%.
You're listening to Slick Talk, the hospitality podcast, a podcast for those who are in and around the hospitality industry who love, live, and breathe what they do. You can join us for candid and unscripted conversations with hospitality experts and founders as we go deeper into their personal stories while they're sharing their triumphs and trials that got them to where they are today. I'm your host, Will Slickers, and you're listening to an episode of Slick Talk, the hospitality podcast. Now, let's begin. In hotels and vacation rentals, the top complaints or issues are noise, garbage, and parking. I may not be able to solve all of your parking and garbage problems, but I could definitely help with your noise problems. And that actually might just help your garbage and parking problems too. So NoiseAware is the only 100% privacy-safe noise monitoring solution that property managers and owners can use in order to ensure they avoid parties and other issues happening at their property. You won't get notified when a plate breaks, but if you have a little quiet get-together that kind of gets out of hand, like this, then NoiseAware will give you the peace of mind to ensure that you and your property, and of course, your profits, are protected. So use my code SlickTalk20 to get 20% off of all noise monitoring devices and focus on the other important things that help you run your business. Now, thank you for checking out Slick Talk, the hospitality podcast. Get back to the episode, and don't forget to check out NoiseAware while you're listening. All right, everybody, welcome back to another episode of Slick Talk, the hospitality podcast. And I have the man, myth, and legend, Brooke, who is the founder of Vintory, back on the show today. Welcome back to the podcast. How are you doing?
I'm doing fantastic. Thanks for having me again.
Of course. Yeah, we've been chatting recently. You're part of the Hospitality FM family. So, of course, it was just a natural effect to just say, hey, let's get you back on the podcast. Let's geek out about some inventory and what that looks like in the vacation rental space when it comes to value. For any of the listeners that didn't hear Brooke's story prior to today, you need to go back and check out the first episode that we're going to link in the show notes just because it's that good. And I think we were going over the 5 top hacks to grow your inventory and to even up your website. I remember we did a lot of the changes that we talked about on the podcast on our website, and it's been really great for our business. So, yeah,
Great.
you guys have some good stuff and good content.
Glad you liked it.
Of course. Well, before we jump into the value of new inventory and value of inventory as a vacation rental management company, can you just give us a snapshot of kind of your founding story, getting into the space, getting into vacation rentals, and then of course starting Vintory and realizing like there's nobody doing this, and we really need to take over.
Yeah, and so I stumbled into it like most people do back in 2007. Started a vacation rental company in Ocean City, Maryland called Vantage Resort Realty. Built that company pretty quickly. We grew it to about 500 properties under management. I exited that business in 2013 and really just been focused in really all things inventory acquisition ever since then. And it was something that I really enjoyed. And it was something that I was blessed to be, pretty good at. And about 3 years ago, coming this March 1st, had the idea to launch Vintory. And the mission of Vintory from the beginning was to really level the playing field, right? It's to help professional vacation rental managers grow their inventory. So take all the resources, take all the tools, take all the systems and processes and team that these large venture-backed companies have, but bring it down to the average mom and pop shop, if you will, and allow them go, head to head, toe to toe against the big boys. And that's what we've done.
So how much has changed from when you grew 500 properties in your property management company to what you guys are doing and seeing with Vintory clients and just what you guys created? Because you have your own custom CRM, like you're really building something unique, and there's nobody in the space doing it. So what are the big changes from when you were doing it to now how you're helping others?
Oh yeah, I mean, well, a lot's changed. I mean, first off, I was the guy using Excel, and funny thing is, I went to many of the property management software companies and asked them to build a CRM, like an owner CRM, if you will, and
Yeah.
none of them would. So literally, I was just using Excel, and I didn't really have a lot of the digital marketing expertise that we do, on our team right now. So we were just doing traditional, direct mail was really our key thing, but we just continued to do it. We saw the value of it, and we're going to talk about that today, right? And that LTV to, lifetime value to CAC, customer acquisition cost, and it paid off, and we just kept on doubling down on it. And luckily, there wasn't a lot of other sophisticated, marketers in our market either. And honestly, there's not a ton of them today, other than the partners that we partner up with.
Awesome. Well, let's jump right in. I know we have a little bit of a sheet to go off of because this is all very new for me, and I love that you helped organize this. So let's go into the value of new inventory, the value of inventory. What are the metrics? What do we need to look at as property managers, and what do we need to understand from an industry perspective? Because I know you and I've chatted a little bit, and there's really no one educating anybody about this segment of vacation rentals. You just told me a story, someone for 30 years has run a successful vacation rental management company, still never knew the value of adding a new property to her program. So, yeah, tell us all about this.
Yeah, so and that's the kind of the first part of it, right? Is like, understanding the value of inventory. Most vacation rental managers that I've met have never gone through the exercise of actually doing this. And I'll be honest with you, I didn't even go through this exercise, when I had Vantage. So I feel it's so important to understand what one property is worth, not only from the annuity aspect of it, but also from the, if and when you decide to sell your company, you're going to get a check for every one of those management contracts, because that is the true value of the company. So what we're going to talk about today is, again, we're going to talk about the annuity aspect valuation of it. We're going to talk about, what some of these contracts are going for at sale if and when you do decide to sell your company. And we'll talk about some of the key metrics based, around that. So first up, so I've asked this question, probably close to 200 times. And what I do is I ask the average vacation rental manager what falls to the bottom line as a percentage of their gross booking revenue. So this would be like the owner rent, right? This is your gross booking revenue before taxes and fees. And typically, if after asking this, like I said, close to 200 times, the average always comes out to about 10% of gross booking revenue. So if you have a property that's doing $36,000 in gross booking revenue, multiply that times 10%, you're going to get $3,600 in margins or net profit, right? And here's the irony. Will, it doesn't matter if you're a property manager in Vail charging 50% or you're a company like I was in Ocean City charging 13 to 16% in commissions. The net always comes out to be about 10%. Now, you do have some outliers. This last couple of years have been really strong years for people. So we've seen that inch up a little bit, closer to 11, 12, 13%. But typically we see about 10% across the board. But here's the thing. You don't keep a property in your rental program for 1 year, hopefully, right? Hopefully you keep in your rental program for many, many years. And, people, have a hard time well, I don't know. I've got some properties that have been in my rental program since I started, 20 years ago. And I have some properties that literally churn or leave your rental program the second year.
Yeah.
But the best way to understand what is that lifetime in years is to take an average. So look at the last maybe 2 to 3 years and say, what percentage of my inventory do I lose in a given year? And what we found across the board is the average is about 10%, right? 10% of the inventory ends up leaving. Now, this, last year with the hot real estate market, that number got a little bit inflated, but if you take an average over 2 to 3 years, you're looking about 10%. So to understand what your lifetime is, you just take one divided by your churn rate, which in this case, their average is 10%, and that gives you a 10-year lifetime. So you have this property that's making you, let's say, $3,600, a property doing $36,000 in gross booking revenue. You make $3,600 in year one. You keep that property in your rental program for 10 years. The lifetime value is $36,000 in profits. So here's the thing, though, right? Quick little, obviously, you probably recognize some of those numbers. If you fall in line with the industry averages of 10% gross margins, net margins, and 10% churn, your gross booking revenue becomes your lifetime value, right? So if you have a property that's, you just sign up, let's say you sign up this killer new property, it's doing 50,000 in gross booking revenue. Well, immediately, if you fall within the industry averages, your lifetime value in profits is going to be 50,000. You sign up another property that's doing 100,000, you know that the lifetime value in that property is $100,000 in net profits. That's amazing if you think about that. One property is worth, potentially $100,000.
So how big of an impact is that? Because we're seeing companies get acquired or go public for insane valuation numbers. Granted, they also have a great inventory scale amount. So but $100,000. So like a small management company, let's say, has 55 homes, and they're let's say their average is $70,000 to $80,000 of lifetime value, and how does that impact their what do you call it, acquisition? Like if they're getting purchased, so if they're selling the business, what does that equal to? And does it just equal that $100,000 to the $78,000 that they're
Yeah.
worth?
So if you're talking about the value of a property at exit, right?
Yeah,
It's going to be, typically, there's multiple formulas you can do, but typically the average way the most companies are acquiring other management companies, it's a multiple on earnings. And just
okay,
to be clear, Jacoby Olin at C2G Advisors is who we recommend for all M&A transactions. He does a fantastic job, and he obviously knows this much better than us. He could give an entire course on this. But typically, at a very high level, we typically see anywhere between 3 to 5.5 times your EBITDA, right? Your profits is
yeah,
what ends up becoming the the multiple there. So if you have that same example we took from before, a $36,000 gross booking revenue property, and you have $3,600 in EBITDA or net profits, you multiply that times, let's just call it 4. It's kind of like an average. You're looking at a little over $14,000 is the value of that one contract when you decide to sell your company. So think about that. You're
yeah,
making this annuity over the life of the property, and then boom, when you're ready to sell, you go ahead and sell. You're getting a $14,000 check for every one of those properties. So you go sign up, 10 properties this year that are all doing those numbers. You're going to get an extra $144,000 when you go to exit. If you go, generate 20 properties this year, you're going to get an extra $288,000 when you go to sell your company. Let's just say you want to reverse engineer this. Let's say, you know what? I want to have $1 million. I want to get an extra $1 million at retirement because I want to buy this big boat or I want to buy this big house, right? Just reverse engineer it, right? $1 million divided by 14,400 per property, and you're looking at 70 properties. So if you get an extra 70 properties over the next, call it 2 to 3 years, you're going to get an extra $1 million when you go to sell your business. So it's think with the end in mind, right?
yeah, 100%. And so, what are the biggest? I don't know, for vacation rental managers, like we've been kind of talking, like you're having to educate a lot of people on this stuff. What is the biggest piece that they're missing when they're signing up properties? Are they undervaluating the property when they sign them? Are they, I don't know, what's the biggest, I guess, mistake when it comes to property managers getting their inventory and then realizing, when it comes to exit or be acquired, that they maybe potentially left money on the table, or I don't know.
Well,
I'm just
I think it's just they don't know that how valuable this inventory is, right? So they don't have a system in place to add properties to the rental program. They're not, they don't have a proactive campaign to go out there and acquire new properties. They don't have they're not doing some of the basics. Like They're optimizing for guest reservations. They're optimizing their website for bookings. But on the owner acquisition, a lot of times you can't even find a good property management page on their website. It's buried under the menu structure, right? And this is what one of our strategies we talked about last time. It's like have a really good landing page to acquire these leads and then have a good system to follow up on it, right? You know, if I think if you understand how valuable every one of those contracts are, you're going to think a little bit differently. You're going to put different systems in place to capture those leads and convert them, and hire a business development person potentially. You know, if you don't have the bandwidth to do it, and many look, I've been in their shoes. I understand how busy the average property manager is. You know, you're juggling 14 different things, and inventory acquisition becomes one of those things that's important but not urgent, so it doesn't get done. But if you recognize and you're one of those people that you don't have the bandwidth to do this because you are waking up at 5 a.m. and work until 10 o'clock every night, hire a business development person to do it for you. And they will pay for themselves. The math pencils out. The ROI is there. If you hire the right person, they will pay for themselves 10x. I guarantee it.
And obviously sign up for Vintory and have you guys get them a class.
Shameless plug, yes. Or if you don't have the bandwidth, just hire us and we will help you with your inventory acquisition needs.
100%. Well, I want to ask you about, because I've seen you talk about on LinkedIn, you know, the value of a property via Vacasa. So going through the Vacasa documents and the decks and all the all the numbers that we're seeing with acquisitions and inventory. So what does it look like when it comes to a property value in a big company like Vacasa? And we could probably even one of these days go into Sonder, as they just went public, and all this other stuff too. But just kind of curious for these big boys, the big competitors that really eat everybody's lunch. For maybe the smaller property manager from 10 to let's say 150. What does that look like for them in order to kind of, I guess, maybe use them as a comparison?
Yeah, and so first off, I love the fact that Vacasa is public now because they have to disclose information, so it definitely makes it a lot easier. But before we get into Vacasa, just in general, the value of a contract at exit, we talked about kind of these multiples. But what I've seen from, we had an M&A division, mergers and acquisitions division, so we saw a lot of deals. But I've seen them anywhere from as low as $7,000 a contract to as high as $50,000 per contract. But the range is typically high teens, maybe call it $20,000 to $30,000. So I want everyone to think, as soon as you sign up a new property, you just think of it as like, boom, I'm getting another, 20 to 30K when I go to sell this business. I mean, there's an extra check, So again, see the value of that. But what we saw from Vacasa acquiring a couple of these companies, when Vacasa purchased Wyndham, they paid $18,000 per contract.
Wow.
Well, when in the investor deck that was published this past July from Vacasa, which is a great read if anyone has a chance, and I'm sure you can post it in the notes here. Will, it's just, you get some really good information, especially if you read some of the fine print. But their corporate development, so that means their M&A, they are averaging a $21,000 per contract is what it's costing them. So Vacasa, I think from the beginning, if I'm not mistaken, they're averaging 21K per contract. But here's the interesting fact. They also published on that investor deck. They're still getting a 25% IRR post acquisition, even after paying $21,000 per contract. So they're still super profitable, even paying that kind of money for it. And then, I mean, the bellwether was when Vacasa purchased Turnkey. They paid $103,000 per contract. Absolutely unbelievable. So again, there's value in contracts. There's value in contracts. There's value in contracts.
So why were they paying so much in the Turnkey, contracts when theirs are, only what, 20? You said 21,000. So why is Turnkey so high?
I don't know. There's obviously lots of theories and things like that, and I don't know what was in, I wasn't in the board deck when they were, or in the boardroom when they made that decision. Obviously, Turnkey, supposedly has a lot of technology, so that gave them a little bit of a bump. So maybe, you can kind of factor that out of it, because again, Vacasa, when they went public, they were trying to position themselves as a technology company so they can get a higher multiple than a traditional, property management type company. So, and I'm sure there was some other synergies that they had on there, but it was a pretty significant number, that's for sure. And I'm sure they got a nice boost once they went public. They got a boost on that. So it made sense. And trust me, Picasso has a lot of smart people that understand this, and they didn't do that. There was a strategic reason for sure.
Yeah, I can imagine. Just a random kind of question, because we've been seeing, I think you probably even saw it at VRMA when you and I got to meet in person, was, we're seeing a lot of property management companies actually shift, maybe not fully away, but some of them fully away from management operations to tech. What's your overall thoughts on that? Is it just a valuation play, or is it finally, just maybe from what you're hearing from property managers that are in Vintory, is that the technology is so scattered throughout the industry, having 20 different tabs on your web browser to log into and connect to, and granted, yeah, they talk to each other and connect to the property management software and all this other stuff, but still have to log in individually for all these accounts. Is it because that's finally a problem that people are just trying to solve, or do you think it's really a big valuation play? Hey, Emmanuel, what are you doing in this episode? Did I forget a meeting?
Hey, Will. No, we don't have a meeting, but I love tuning into the recording, so I figured I'd hop in.
Oh, awesome. Well, hey, since I got you here, do you mind sharing some stuff about Jetstream? Ever since our episode on Slick Talk, we get tons of questions about you and, of course, Jetstream.
Of course. I'd love to share. Anything specific?
Well, I keep getting asked, what's the difference between Jetstream and any other service or tech in the vacation rental industry? My simple answer is that Jetstream isn't just the tech you need, but it's the people too. Am I close?
The short answer is yes. You see, maybe you're a short-term rental operator or a realtor or an investor. If you have an interest in short-term rentals and hospitality, you're looking for the most efficient way to either enter the industry or streamline your operations. You've got two options. Option one, the hard one. You find a PMS, hire staff, learn the tools, figure out OTA distribution, train yourself, train your teams, price your product, deal with customers, and you do everything yourself. Option two, partner with Jetstream. Jetstream is a complete solution that maximizes your revenue in the short-term rental industry without increasing your fixed costs. Jetstream handles everything.
So I don't need to sign up for vacation rental software or worry about distribution headaches. And what about branding? What if operators love their brand and name? Do they have to give that up in order to be powered by Jetstream?
Absolutely not. Jetstream does all of this white labeled under your brand name. Everything. You focus on delivering on-site guest delight and growing your inventory. Jetstream handles the rest. And to make it even easier for your listeners and anyone else who stumbles across this podcast, anyone who mentions code SlickTalk50 will receive 50% off the first 3 months.
All right. Coming in big with the 50% off for our listeners. Well, hey, Emmanuel, I just want to say thank you so much for shedding some light on the power of Jetstream and being such a great industry partner. I do have to get back to this episode, though, but let's get together soon for another virtual happy hour. First round's on me.
Sounds good, Will. See you soon.
Well, there was an editorial written by Mark Andreessen over, I think, a little over a decade ago. And if you don't know who Mark Andreessen is, he runs the largest VC firm out in Silicon Valley, Andreessen Horowitz. He also was a founder of Netscape. And he wrote this article that said software is eating the world. And again, this was 10 years ago. And what he, talks about, and I highly recommend everybody reads it because it's really amazing to see what he kind of forecasted, a decade ago. And he talks about how in the future, there will not be software companies and non-software companies. Every company will be a software company in some capacity. I mean, look at even like Tesla is a perfect example, right? I mean, Tesla really is a software company, it just happens to be in the form of a car. And even if you look at additional, car manufacturers, they're all going that way. And supposedly, Apple is getting into autos as well. And we'll see what happens. But I think the future of all companies will definitely have a huge technology base. And I love technology personally. We started really as a marketing agency, but shifted into technology. And that was part of our play all along, because it's infinitely scalable, right? It's bits versus atoms, right? It's more code. You really don't to scale a business. You can do it much more efficiently in a software manner than you can, and actually having people and hard assets and things like that. So I think eventually every company will end up evolving to that. I mean, just look at the number of, I would say, just in your business right now, Will, count the number of software tools that you're using, and it's pretty amazing. And I know I was just going through an expense review we do every quarter, and I was just like, it blew my mind how many different subscription software companies that we had, even on our platform.
Yeah, no, I'm doing the same thing. And I was just even looking at Spotify. Everyone, when they hear the word Spotify, they think either of, Joe Rogan or Call Me Daddy or whatever these big podcasts are. But then if you actually look, they own 3 other software platform companies, one called Megaphone and one called Anchor, addressing 2 different markets on the audio spectrum: listeners or creators, and then advertisers. And then of course Spotify is their listener platform. So it's really interesting if you think about, like, everyone just thinks of Spotify as a podcast player, but there's also these different facets that different, maybe audiences in the audio or audio space. So yeah, 100%, very much so a software business along the way.
Yeah.
But I'm kind of curious for hacks. I know we kind of went into this our first episode, hacks on how to create the best property manager landing page. That was really important. Again, like I said, we applied all of that to our business, and the landing page is probably, the owner's page is actually probably better than the guest page. But at the end of the day, that's what we're trying to grow. Is we get bookings all day long. We don't need to worry about that. We definitely need more inventory. So for those who are in that same mindset, they're not worried about their calendars. The owners aren't worried about their payouts for their properties. The property managers are worried about getting more inventory, and maybe even some real estate investors that are handing off these properties to managers. So what are the biggest hacks in the sense of growing inventory, growing that lifetime value inside of a contract?
So what are some hacks on how to grow your inventory? I mean, is that specifically?
Pretty much, yeah.
Wow. I would say the first thing to do is listen to the last episode we did, and we highlighted 5 different hacks. But I mean, look, I could literally talk for hours and hours and hours on different strategies and things like that. But just real quickly, just highlight. I'll kind of give a little tease. So update the landing page, right? You talked about that. You already have this organic traffic already coming to your website. Optimize it, right? Make sure you're capturing that. Have a form above the fold. Have a meeting scheduler link on there. Make it easy to book an appointment with you. Second thing is follow up. When we secret shopped over 100 vacation rental management companies, most of the time nobody actually even responded to us. Wow. So that's a big one. Use some kind of CRM to track leads, right? We've seen a lot of our partners, Will, up to 50% of their deals are actually coming from leads that were in the long-term nurturing sequence at one point. Direct mail still works. It's vacation rental industry is one of the few industries where direct mail still works. But the key is going to be consistency. Just continue to drip. Get your ICP, your ideal customer profile, get the data. And there's a lot of other, we could do an entire session just on data, but just continuously drip out the direct mail, whether it's postcards, whether it's simple letters, whether it's even just informational, like leverage some data from key data dashboards and push it out there, and just position yourself as the authority, as a leader in the space. And, look, people are in different phases of the buyer journey. And you just want to move them along, so you want to continually drip, and people are not ready. The good thing with direct mail too, is it has a long shelf life. We see, because we track every one of our calls. Every campaign we have has a call tracking phone number on it. We see people calling a year and a half afterwards from some of these postcard campaigns that we do. And then, you have digital, there's lots of digital campaigns, manage the PPC. The problem with PPC is it just, there's not a lot of search volume. So you want to really have a long tail. You want to have a lot of different key search terms that you're pulling for. But again, and then you got to make sure you're sending them to a really optimized landing page that's really optimized for conversions. I could go on and on and on. Referrals. Referrals are huge. Build out all these campaigns that you're doing for guests. Guess what we do? We actually put those same exact marketing strategies, but we go after realtors, because realtors are the number one referral source. And don't be afraid to pay referral fees. When you look at the CAC, right, it's kind of like the OTA, conversation. Like, you have an acquisition cost for a guest. Well, guess what? You have an acquisition cost, which we're going to talk about in a little bit here, for the owners. And don't be afraid to pay a realtor for that referral fee.
100%. I was just going to say that. And I'm glad that you brought up CAC. So can you explain, because you said some terms in the beginning of the episode, when it covers, all these, inventory metrics, right? So what is CLPL or CPL and CAC? And then of course we have LTV and CAC. Just for the listeners that this is all brand new, you and I could probably use all these acronyms, when it comes to RevPAR, revenue management, all these other things too. But just to make it easy, let's jump into these terms and what they mean.
Yeah, and I apologize. Obviously there's lots of, and I could totally nerd out on these things. I love inventory metrics. I literally could talk. I've given a session at Amy's Data and Revenue Management Conference all about vacation rental metrics. Actually, we've got a webinar on our website if anybody wants to really drill down to it. It's pretty cool if you're a nerd like me. So, but CPL stands for cost per lead, right? It's pretty simple, right? What's your average cost per lead? CAC, or customer acquisition cost. How much does it cost you to acquire a new customer? And then LTV is lifetime value. So what is that? We talked about this before. What is that lifetime value of a new contract coming into your program? And then kind of the holy grail of all metrics is the LTV to CAC ratio. So it's kind of like just taking, what does it cost you to, it's kind of like unit economics, right? What does it cost you to acquire a new property? And then what is the lifetime value of that property? And you kind of come up with a ratio. We can talk about each one of these. But what we're seeing across the board from, paid, deals and leads, we're seeing a cost per lead anywhere between $200 to $300. So this doesn't count your organic traffic that's coming in through your website. This doesn't count, potentially a referral from a, realtor. This doesn't count a referral from somebody else, but just the proactive direct mail, proactive PPC, any, list-based retargeting through Facebook, Instagram, LinkedIn, things like that. We're seeing an average cost per lead like $200 to $300, which at first blush sounds kind of higher. Like, man, I'm paying that kind of money for it. But if you go through the math of it and kind of go through the calculations, it actually is well worth it. We're typically seeing a conversion rate, and it really depends, right? It depends on your program. It depends on the closing capabilities of the person that's actually answering the phone, things like that. But we're seeing conversion rates anywhere between 10 and 25%. So if you get 100 leads in, you're going to close anywhere between 10 to 25 of those. So that puts a CAC, a customer acquisition cost, if you kind of follow the math on that, of anywhere between $1,000 and $3,000 per new property. Now, it depends on the market you're in. It depends on, if you're only going after $100,000 plus properties, it's going to be on the higher end. If you're taking, properties that are doing in the 30,000s, it's going to be a little bit lower typically. And it also depends on your brand. Obviously we see some of our partners where they're a brand new brand. It takes a little bit of time to get going. Nobody wants to be the guinea pig, right? Nobody wants to be the first management, property in your management program, right? So it's sometimes we see a little bit, higher conversions and things like that on more established brands out there. But if you look at, so if you take in these kind of numbers we talked about earlier, right? So you have this outlay of, call it like $1,000 to $3,000 to generate a new property, but the property is going to stay in your rental program for hopefully 10 years, right? And if we use those same numbers as before, you're going to end up making about, assuming a property doing 36K over the lifetime, you're going to make $36,000 over the lifetime. So you outlay $1,000 to $3,000, but over 10 years, you make $36K. But remember, Will, if and when you decide to sell your company, you're going to get a check. And we did the math before. The average was about $14,400 for a property doing 36K. So it's just, to me, it is an incredible, payback if you actually go through that exercise. And what we're seeing in the LTV to CAC ratio, again, this is kind of where we call it like the holy grail of all metrics. We're seeing anywhere between 10 and 20x is kind of like the ratio that we're shooting for.
Wow. I was going to say, I'm glad that you brought up brand, because that was actually kind of a question in the back of my mind. With all the clients that you guys are working with, property managers that are onboarding with Vintory, how I don't know how to phrase this without being like too. I'm a big brand guy, so like I'm all about proper logo, proper website, none of this like sometimes I go on websites and look like they were made in 1995 and they never changed. So how important does that add to not only just your property contract inventory value that you can use to, up when you go through an exit, but how big does brand have on the impact of a sale of a business in the space?
Well, it first off, just on the acquisition of new inventory from a homeowner, right? I mean, you think about it, a website is the new storefront, right? That is your brand. That is a reflection of you. If you go to a website and you're thinking about putting your property in their rental program, and it looks like it was built in the 90s, you know what I mean? It looks like, the pictures are outdated. That's a reflection of the brand. I mean, I would be turned off immediately, and I would not sign up my property into that rental program if I see it. So the first thing to do is update that website. Again, this is a reflection of who you are. It kind of goes without saying. And then you want to just, obviously, it's two parts to it, right? It's the reflection of that brand, but it's also what are the parts within your brand? What are the parts within your rental program that make up who you are, right? Like we talk, this is one of the coaching sessions we do whenever we onboard a new partner. It's we go through that. We want to reduce friction,
Yeah.
in the buying process. Like, what can you do to make it as easy as possible? So it's not only just about great marketing, right? You got to have the program to back it up, right?
Yeah.
How can you? I mean, I see a lot of property management companies. They make it more difficult and more challenging to sign up into a program. So again, you want to reduce that friction. You want to make it easy. And, for example, a couple of things like long-term, what are the things you can do that kind of eliminate that friction in the buying process? So like eliminate startup fees. I mean, some people are putting these crazy startup fees in there, and I understand why they do it. But if you look at how much that property is going to make you over the life, and they're choosing between two different companies, and you've got a $500 startup fee or a $1,000 startup fee, and the other company doesn't, they're probably going to go with, there's a high probability they're going to go with that other company. So reduce those barriers when you're in your rental program. Like, here's the thing. We ask this question all the time. It's, what happens if a property owner decides to get out of the contract? Are you going to let them out? They usually say they have a year contract, a 2-year contract, something like that. If somebody wants to exit your rental program, are you going to let them out? They're like, yeah, of course, it's not worth it. Well,
Wow.
then why do you put a long-term contract in there? Eliminate the friction, right? Make it as easy as possible. Again, it's risk reversals. The best risk, I tell you what, Evolve launched this new risk-free guarantee program where I'm see if I can remember it. It was, they will give you a refund of all of your fees. They will
Wow.
give you a refund. They'll give you a refund of all your fees up to 6 months. And it's amazing, right? You can cancel for any time and they'll give you a refund. And it just, to me, it's like, what do you have to lose, right? It's nothing.
Are you seeing property managers just take away the minimum commitment of a year? Are they just saying, hey, it's month to month, 30-day out clause? What's that look like?
We are, if they're giving them out, letting them out anyways, absolutely. Right.
Yeah.
We're seeing them eliminate that. And why not? If you're going to let them out of the contract anyways, you might as well do it. And again, Evolve's new guarantee, to me, it's a great risk reversal. If I were to go through that pitch, I could see their business development person selling that, going over all the highlights of the rental program. And they say, look, and if for any reason after 6 months you're not happy, you can cancel at any time. We'll give you a full refund of all the management fees charged. Now, if you read the fine print, this is where it gets interesting. I believe it's only from 6 months to 7 months. You have to cancel at that point. And you think about it, you probably haven't ramped up a ton of cash at that point, or reservations in those early months anyway. So it's, or you're probably sitting on a whole ton of reservations, so you don't want to walk away from them either. So to me, I would go to and mimic that. If I were starting a management company right now, 100%, I would duplicate that guarantee, that risk reversal.
That's literally something I'm going to talk to my business partner today and be like, hey, we got to talk about this.
Well, look, here's what's going to happen. Well, sorry to interrupt, but you are going to have to refund 1 or 2, right? It's going to happen. But from one person would look at it, oh my gosh, we had to refund these fees. But you know what? We just signed up 20 extra properties. What's the lifetime value of those 20 extra properties? It is the biggest no-brainer ever done,
100%. Oh, 100%. And it just makes sense. And the more I think about, because like we always kind of talk about the art of convenience, right? You said make it so easy. And one of my friends, I think you know her too, Brittany, from Breathe Easy Rentals out in Florida.
Mhm.
She talks about, we overcomplicate things so much in our industry. Like you just said, like you did your quarterly review. How many subscription platforms did you have that maybe, I don't know if you probably do need them, but how many of them do you think you didn't need? Like so many people just sign up for everything and they just add all this new stuff to make it, thinking it's going to help their business, but really they're just complicating their whole operation. And so if you can make it that easy, you might as well. And I have a random question.
Yeah.
Never actually talked about it on a podcast, but we've been seeing the rise of crypto and NFTs and Web3 and all this other stuff, and we're seeing a little bit of talk in the industry. I'm curious, do you think management contracts will go into an NFT format at all? I don't know if that's anything you dabble in, but
like know where your strengths are, and I've not done. I've just dabbled a little bit here in some Bitcoin and some other crypto, but it's not really my wheelhouse. But I do think there is going to be some interesting things coming with Web3. That's for sure.
Okay. Yeah, just something we kind of talked about. We had Luca from Trips Community on our other podcast a while ago, and it sent me down a big spiral and rabbit hole. So it was like something like, oh, can we make a management contract that's NFT? But it's pretty far out there, at least for us. But no, this was really cool. So I guess the last question that I like to ask every guest is, where can people find you? What's the one shameless shout out plug that you want to give?
Yeah. So obviously our website, Vintory.com, or follow us on LinkedIn, where we push out a ton of content, ton of information on LinkedIn. If you go to our website, we have tons of webinars and videos and training things. And we're actually building out a training course right now for free for everybody. And again, our goal and our mission from the beginning is to help every single vacation rental manager grow and scale their inventory.
I love it. I love it. That's so good. And I think we were talking about the topic of today's episode, and I was like, oh, didn't we talk about this on the first episode? But no, you guys are pushing out so much content on LinkedIn that I'm absorbing and watching that I thought we did, but we didn't. And so it was great to be like, oh yeah, that's why. That's a good problem to have. The amount of content's so invaluable in this day and age, and especially in our industry. There's no one really talking about inventory and the value of a contract the way you guys are and putting it out. So just want to say thank you so much for one, doing a deep dive on the podcast, but then two, just continue to push out that value throughout the industry as you guys do. It's been incredible to watch.
My pleasure, and thanks for having me on the show, Will. Let's do it again.
Amen. Let's do it. All right, you heard it first here, Slick Talkers. Go ahead, check out everything in the show notes, so that way you can like and subscribe everything Vintory. And of course, listen to the first episode that we did not too long ago in 2021. And we'll see you guys all again next week. Thank you so much for listening, and thank you to our show partners for making Slick Talk, the hospitality podcast, possible. We hope you enjoyed the show, and we would love to connect with you outside of the podcast. So you can follow us on all of our social media channels for daily hospitality content, or find us on slicktalkthepodcast.com. And don't forget to rate, review, and subscribe so you never miss an episode. I'm your host, Will Slickers, and we will see you guys all again next week. What's up, everybody? If you've gotten this far into the episode of Slick Talk, the Hospitality Podcast, then you are amazing, and thank you so much for tuning in. We want to send you two places really quickly. If you can, check out the show notes and click the hospitality.fm link. Check out all of our other shows on the podcast network. And don't forget, if you have someone that you want to hear on the podcast, then fill out the guest fill out form so that way we can get them on the show. Thank you so much for tuning in, and I hope you enjoy another episode of Slick Talk, the Hospitality Podcast.